Hello, everyone, and welcome to another faith-driven financial planning workshop. We're going to go ahead and get started. I see a few people are joining us, so give them a few seconds. So welcome, everyone. My name is David Sandu. I'm a financial advisor, and I'm welcomed by my wonderful co-host here, Jared Williams, who is. I'll let him explain who he is and his role. But I just want to get started with talking about a scripture that's really the heart and soul of what I consider faith-driven financial planning, and that's First Timothy 6:17 through 19. And it says, "Command those who are rich in this present world not to be arrogant or to put their hope in wealth, which is so uncertain, but to put their hope in God, who richly provides us everything for our enjoyment. Command them to do good, to be rich in good deeds, and to be generous and willing to share. In this way, they will lay up treasure for themselves as a firm foundation for the coming age, so that they may take hold of the life that is truly life." And that's First Timothy 6:17 through 19. So I'm excited today. We're going to be talking about long-term care insurance and why earlier is better. Before we get into the meat of the material, I just want to make sure everyone on the webinar understands that this presentation and the things that we'll be talking about are not specific tax, financial, or legal advice. Everything we're going to be talking about is general information and educational in nature. So who am I? Well, and I'm going to let Jared explain who he is and share his background. But so who am I? I'm a former rocket scientist. I worked at Raytheon, SpaceX, and Lockheed. And I'll share my story, but I created the faith-driven financial planning system, and that allowed my wife and I to pay off $100,000 of college student loan debt, save up an emergency fund of a year, become millionaires by the time that we turn 33, give over $150,000 in charitable donations, and then finally pay cash for the last three houses we've owned. And that's something that I just want to say, I bring glory to God for that, because He gave us the wisdom that was found in Scripture to apply those biblical principles to our finances. And I have had the wonderful pleasure of teaching and advising hundreds of other families to accomplish similar goals fast. So my story starts actually with my dad. This is a picture I took with my father about 10, 11 years ago, a couple years before he passed away. And while we were on a cruise, I took my parents on a cruise, and I asked my dad if he had any investment or retirement accounts, and he said, "Yeah, David, I have five investment and retirement accounts that I've been saving and investing into over the years." And the punchline here is he has five kids, and I'm one of his five kids, and so we were his five investment accounts. But about 10 years ago, my father really suddenly passed away in his sleep. He had a heart attack in his sleep, and of course, it was a shock for everybody. And so I was actually in Guam at the time. I was working overseas, came back to the States and helped my mom through a lot of these tough financial planning questions. Being the money nerd of the family, everyone looked to me to kind of help her understand kind of what was left, what was there, what was available, and it put a spark in me to really help other people with their finances. And I knew I wanted to do it from a biblical perspective, because growing up as a Christian, God and the Bible have always been a strong influence in my own personal life, and so why not? Why would it not be part of my financial life? And so I started teaching Financial Peace University. I started helping other people just for free. And long story short, I was working actually at SpaceX at the time when I was doing this. I was working 80 hours a week at SpaceX, and I was volunteering my time 20 hours a week. Teaching and helping Financial Peace University students, and my wife said, "Okay, enough's enough. You need to pick one." And so I ended up studying thousands of hours of what does the Bible say on money, and can I really do this from a biblical perspective? Ended up interviewing Ron Blue and just understanding what does financial planning from a biblical worldview look like, and so really wanted to implement that into my life, and that's where I uncovered biblically responsible investing, and I found a team of financial advisors that implement biblically responsible investing into their clients' portfolios, and so that was a huge mindset shift for me. Biblically responsible investing, I wanted to align my faith with my investments and bring glory to God. And so that's what got me started on the path. And I started sharing the message of biblically responsible investing to anyone I could. And it got picked up in the Yahoo Finance article. They interviewed me for one of their articles, and it was a huge opportunity for me to share more about biblically responsible investing and also just biblical financial wisdom, and what God has to say about money. And so that brings us to what I call the faith-driven financial roadmap. And like I said, I brought a lot of the financial and biblical principles into my own personal finances, and that helped me to establish what God says about money. And that's why I created the Faith Driven Financial Roadmap. This is the roadmap that my wife and I use to get out of debt and to set our family up for financial success, all according to biblical principles. So before I introduce Jared or let him introduce himself, I'm just going to walk through the Faith Driven Financial Roadmap, because obviously today we're talking about long-term care, and long-term care is a big part of stewardship, I believe. I mean, when I think about stewardship, I think about God owning it all. I think about how can I be a better steward of my own personal life, but also my family, and protecting my family from financial emergencies. So I'm just going to walk through the Faith Driven Financial Roadmap very quickly and briefly. If you have more questions about it, we can chat offline. The first one is to start giving. So I believe that it is more blessed to give than it is to receive. That's step one. Step two is protecting your family from financial emergencies. And this would be anything like death, disability, high deductibles, and long-term care. And so protecting your family, I think, is just a part of being a good steward, and really keeping them safe from financial devastation. And number three here is maximizing employer benefits. Obviously, everything that we do, our work is unto the Lord, and so as being a worker, we have opportunities to maximize our employer benefits. The three biggest missed ones that I see are people not optimizing their Roth 401k, their health savings account, or optimizing their employer matching. And so a lot of times employers will match gifts to nonprofits and charities, and so I see a lot of people missing that, especially people of faith that want to give more. Fourth one, pay off high interest debt. A lot of people are burdened by credit card debt and they don't have a plan to get out. So whether it's the debt snowball or the debt avalanche, a lot of different ways to pay that off. Number five here is building up those cash reserves. And so typically that would be somewhere between 3 to 6 months of expenses, but really preparing yourself and your family for any kind of financial hardship that might come your way. Number six is evaluating your taxes. And so there's generally three tax buckets: the tax-free, tax deferred, and taxable accounts. And I know long-term care can have some aspects of all of those. And so I know Jared will talk about that more in depth. Number seven, aligning your investments with your time horizon, your asset allocation, and also your values. I mentioned biblically responsible investing is very important to me. I think a lot of people, especially Christians, are missing this aspect of being able to implement a biblical worldview in their investments. Number eight is protecting your estate. I know Jared's going to talk about long-term care, but there's also documents and beneficiary designations that everyone can implement, whether it's a will-based estate plan or a trust-based estate plan. And then there's following documents to protect your assets and your estate from getting tarnished or varnished from a values and a valuables perspective. Number nine here is save for faith-driven goals. And so as people are getting closer to that date of calling it quits from their job, they might be looking to save for faith-driven goals. So that might be maybe they want to purchase a new house or a new car, or save for a roof, or help their kids with college, whatever that is. That's number nine, save for those faith-driven goals. Number 10 is optimizing your plan. As people get closer to retirement, traditional retirement, a lot of ways that people are not optimizing their plan. One of them being long-term care and some of the newer products that are available. But there's other things like taxes, so tax loss harvesting or Roth conversions or donor advised funds that really can come into play here. And then number 11, redefining retirement. There's the non-financial aspects of retirement, and I always tell people it's important that you retire to something, not just that you retire from something, because having a purpose in retirement, at least I've seen with my clients, it has been a huge mindset shift, but also gets them prepared and look forward to waking up every morning. And so there's a lot of different aspects of that. There's long-term care, there's Medicare, there's Social Security, there's tax planning, tax efficient distribution planning, a lot of things that you can do. There's catch-up contributions that can happen during step 11. There's a lot of different things once you hit 50 that you should start thinking about. And so that's step 11. And then number 12 is find wise counsel. And this would be all the people on your team, I would call it. So people like Jared, who are a specialist in long-term care, financial advisors that are specialists in investing and financial planning, Medicare specialists, Social Security planners, all these different types of professionals, estate planning attorneys, and forward-looking accountants to help you with your roadmap. And so a lot of different things we just touched on, and I know Jared is going to touch on more, but as we shift, I want to let Jared give him some time to explain kind of who he is and what he's doing and what he's working on. So Jared, I'll pass it over to you.
Yeah, thank you, David. I'm excited to be here and talking today. So, like David mentioned, I'm a long term care specialist. I'm a partner in the long term care consultants company. We don't have time for my story. It's fairly long, as you know, but been in the financial industry for 12 years now, and some of that time in insurance, and then spent some time actually doing biblically responsible investing, like you. And that's how you and I met. Had some time doing retirement planning, and really excited now that I mean, truly, God has given me an opportunity to be focused specifically on the long term care piece.
Yeah.
And I found that it's an aspect where there's just not nearly enough specialists out there. We have far more demand than supply. So. Um, been married for 16 years. We have 4 children. We're homeschooling the 3 who are old enough to be in school at this point. So, um, that is me. But I don't take up any more time talking about me. So without further ado, we'll get started. Give me a second to get this pulled up and get my screen shared correctly, and then we'll jump in.
Awesome.
If something doesn't look like it's been shared correctly, let me know.
Okay.
Actually, I think I'm gonna have to do this way. Try to bring it up and then share, but it won't let me do that. It's kicking me out. So let's try this. Okay. Are you seeing my screen now?
Yep.
Or
Perfect.
the presentation? Okay, perfect. So we're going to talk about basically long-term care and why earlier is better. Um, this will not be a comprehensive presentation of everything someone needs to know about long-term care. There's simply not enough time. But I did want to hit what I thought were the most important things for someone to understand if this is their first, time really being exposed to long-term care and specifically long-term care insurance. So to start, just what is long-term care? And so long-term care is non-medical personal care. It's often assistance with various activities of daily living and assistance needed due to cognitive impairment. And so it can really be many things, but it often includes, help getting dressed, bathing, using the bathroom, eating, getting around the house, chores, running errands, and all sorts of other things that people need as they become older, as they have illnesses, as they become frail, but aren't specifically medical types of conditions. So often I help people understand, if someone's coming to your home, there's often physical therapists or nurses or doctors who come to your home. That's medical. If there's someone
Mhm.
coming to your home to help with other aspects of your care, that's probably personal and it's going to fall under long-term care. Um, long-term care can be provided at home, in an assisted living facility, and or in a nursing home. And there are a few other options, but those are kind of the big three of where most people are receiving care. And just simply put, long term care is care that is meant to keep us safe. And I think to better help understand what the idea is, what the picture is around long term care, I want to introduce you to the Winsteads. Now, I've changed names, obviously, so everything here, there's no confidentiality issues or anything, but this is a real family. So the Winsteads came to me for help with long term care planning. Jim and Kathy Winstead are in their mid 50s. And I'd also like you to meet Kathy's parents, Bruce and Ruth. And so Bruce had a stroke 5 years ago. Ruth became Bruce's primary caregiver until he passed 2 years ago at the age of 79. Now, of course, Ruth loved Bruce and wanted to give him, the best care that she could. But with Bruce being, bigger than Ruth, it was difficult for her to help him around, help him on and off of the commode, help him in and out of the bath. Not to mention her continuing to take care of everything around the house. And her daughter, Kathy, started to see the physical and emotional toll that this was taking on her mother. And so Kathy suggested that they hire a home care agency to come help take some of the load off of Ruth. And at first, Ruth was hesitant. She wanted to be able to help, take care of her husband herself, but she had to admit that she needed help. And so Kathy helped Ruth find a good local agency, and she began receiving help around the house and caring for Bruce for about 8 hours a day. And while this was extremely helpful to Ruth, it was costing them about $7,000 per month to have that care, which of course they had not planned for. And so thankfully they did have retirement accounts that were able to afford the cost for Bruce's remaining 2 years. After Bruce passed, Kathy could see that her mother's health and physical abilities had declined significantly. Kathy and her husband Jim lived about an hour from Ruth, and so Kathy, was only seeing her about once or twice a month. But it was obvious to Kathy that Ruth was now the one in need of care.
Mm.
And so you see, providing care to someone who is chronically ill often makes healthy caregivers become chronically ill themselves. Providing care to chronically ill people often makes healthy caregivers chronically ill themselves. And so Kathy ended up reaching back out to the home care agency and was able to secure another, 8 hours per day of care for Ruth. But Ruth could only afford this for about 1 to 2 more years at best. And as her health continued to decline, she required more assistance. And who would you guess became Ruth's primary caregiver?
Hmm.
Kathy, of course. What choice did she have?
Yeah.
Kathy was an assistant principal at a local high school, and she began driving, 1 hour to her mother's home each day after work, staying with her overnight, and then left the next morning to be back at work. She felt like she rarely saw her two teenage sons. One of them was a freshman, and the other in his senior year of high school, and he was going to be leaving in a few months to go to college. Her husband was, very supportive, and he understood the needs of the situation, but he too, was feeling the strain of rarely having quality time with Kathy and taking over most of the duties at their home. So Ruth did end up passing earlier this year. Kathy was, of course, distraught at the loss of her mother. But if Kathy was honest, she also felt somewhat relieved. And of course, then that feeling made her feel guilty, and she wondered, if she was a terrible daughter. And of course, she's not, right? She was a wonderful daughter. She did what had to be done to help take care of her father, and then later help take care of her mother. But that season had been really uniquely challenging and emotional for Kathy and for her husband Jim. And so one thing was certain: she wanted a plan in place that would protect her children from going through a similar ordeal probably in a few decades, when it was, if and when Jim and Kathy needed help themselves. So she and Jim scheduled a meeting with me, and during our first meeting, I explained that long-term care insurance. And I want you to get this: long-term care insurance is not for the person needing care. The
Hmm.
person who needs care is going to get it one way or the other. We can all think of stories of that. They're going to get it one way or the other. Put simply, if you need care over a period of years, your life is not going to end. Someone else's life is going to end, at least as they know it,
Hmm.
at
Yeah.
least for a period of time.
Yeah, Jared,
Um,
I was going to share a personal story here. So
sure.
this actually happened with my grandmother, and so being in my father's from India, and so in that culture, it's very common that in-laws or grandparents will stay with you. And so I actually saw this happen with my grandmother. My grandmother lived with us for the last 3 or 4 years of her life, and it was hard being one of five kids. And my mom, there was a lot of stress and toll that it took, and so it was hard. It was very very hard to see her go through that. So yeah,
Yeah.
definitely from personal experience, it's tough.
Yeah, I saw that with my mother too, taking care of her mother. She wasn't an hour away, but there were a few years, that she was
Mhm.
there almost daily. And that's not who the story is based off of or anything, but it was a
Mhm.
really similar situation of struggling to afford some amount of home care. And then my mother having to, kind of step up and do the rest.
Yeah.
Experiencing all those, same emotions and everything. Um, yeah, so thanks for sharing. I'm sure most of us, have seen
Mhm.
it, and to some degree or another, even if it's not been firsthand experience.
Mhm.
And so, of course, Jim and Kathy could certainly relate to this idea, and they were really motivated to have a plan and the means to allow their children to supervise their care if the time came, but not to be the ones who had to provide the care. So there's a difference between supervising the care, which is a good role for a family to be in, but it's ideal if they are not the ones who have to provide the care. So hopefully that makes sense.
Mhm.
So we began the process with education and planning. And so the first thing that the Winsteads needed to understand is what does not pay for long-term care. And there's all kinds of misconception around here.
Mm.
But these are the big things that many people think does and of course does not pay for long-term care. So health insurance, it does pay for medical care, not long-term care. Medicare and the Medicare supplements or Advantage plans or anything related to Medicare, it does pay for those. The therapists, the nurses, the doctors, the hospital visits. It pays for those things, all the medical care. It does not pay for any kind of personal long-term care. And then finally, veterans benefits. In most cases, there are some few exceptions. They're usually need-based. So if you would apply for, Medicaid or something, qualify for Medicaid rather, you may qualify for certain veterans benefits. But for the majority of veterans, those benefits are not going to cover any types of long-term care.
Yeah,
So what?
Jared, I just want to
Yeah,
mention this is actually a really common misconception because I teach
yeah,
a lot of retirement planning classes. People always think that Medicare will kick in, and unfortunately, they're thinking about Medicaid, and I'm sure you'll talk about
right.
that. But
Yeah,
it's this really big misconception that people just assume that the government will step in and help them pay, and there won't be any sweat off their back from a Medicare perspective. So yeah.
right. Yeah, exactly. And so, of course, that brings us to the question of what does pay for long-term care. And there are three ways to pay for long-term care. You can self-pay out of your income. You can use long-term care insurance, and then, of course, as you mentioned, David, Medicaid does pay, excuse me, for long-term care. And so, just to clarify, Medicaid, of course, is needs-based, right? Every state kind of has their own sort of version of Medicaid, even though it is a federally run program. But in Tennessee, we call it TennCare. I've heard it called many things in different states. Um, but Medicaid usually only pays for nursing homes, and only after nearly all other assets are depleted. I know here, a family has to spend their well, the person needing care has to have their assets down below to $2,000 total assets, $2,000. Um, Except for their residence, and then a spouse has a certain amount of allowance they can have as well, to keep, but it's not a lot. So
Mhm.
you really have to have self-paid and covered everything yourself before Medicaid is going to step in. And then, again, at that point, you're very limited in options. They're not covering home care, they're not covering assisted living facilities. There are rare exceptions to that, but for the most part, it's going to be a nursing home. So which is the best option for you, which of these three, depends mostly on your health and your financial situation. For some families, self-insurance is simply not an option, right? They don't have
Mhm.
enough money to pay for their own care, at least not for long. They may have to pay for it for a few months or until they run out of money. And they may not have enough money to pay for insurance either. And so that, of course, leaves Medicaid as the only viable option. Many families can afford long-term care insurance, especially if they work with a specialist to help them figure out how to afford it, but may not be able to self-insure themselves. And of course, some families could self-insure. And so, one of the best ways to determine if you could self-insure and if that makes sense is to think through a few of the following questions. And David, this part I can go a little quicker if we are getting pressed on time, but otherwise I'll just
Nope.
keep going forward.
Yeah, you're
Okay.
good. We have plenty of time.
Okay, perfect. So first, imagine that you had to begin paying, five to $10,000 per month for an undetermined amount of time. Okay, so that's kind of the scenario that people find themselves in when they're, suddenly or progressively needing care. All right, so a few questions to consider. If you suddenly had to pay five to $10,000 a month, could you still maintain your current lifestyle and obligations? Which assets would you have to liquidate? And that's what typically happens unless you are pretty high income. People would typically end up having to liquidate assets in order to pay for care. But there's some important considerations there. How would liquidating those assets affect your taxes? If you're already pulling out money from retirement accounts or other taxable accounts to fund your lifestyle, and now you're having to add five or 10,000 a month, so 60 or 120,000 a year, what is that going to do to your tax situation?
Mhm.
What if the market is down, or whatever, asset it is, but what if the market is down, whether it's real estate, stocks, when those assets have to be sold? Are you able to, lock in losses in order to afford this care? And then who else might be depending on those assets? With Bruce and Ruth, it was hoped that those assets that were paying for Bruce's care were going to be there to provide for Ruth, not just for care, but for her lifestyle, or
Mhm.
to possibly be an inheritance. And not everyone needs an inheritance, but some people do, David.
Yeah.
And so it's an important question: who else might be depending on those assets? And then finally, sort of a separate consideration, but even if you could self-insure, what if there was a product that eliminated the financial risk of unused premiums? And so, to help maybe to make that question make more sense, for people who could self-insure and thus could, also afford to purchase insurance, the only reason not to purchase the insurance is if you didn't want to risk, wasting, so to speak, quote unquote, wasting your money for insurance premiums that may never be used, right?
Mm.
And so there's really no other consideration if you can qualify for it. And so, fortunately, there are two main types of long term care insurance products, and both of them are very good. I like them both. They're useful in different situations, but one in particular solves, this particular problem for folks who maybe are higher income or higher net worth and they could self insure and they're trying to decide whether that makes sense. So, I want to take a few minutes and just kind of briefly talk about the two different types of long term care insurance
Please.
policies. And, David, there's other ways of
Yeah.
combining putting things onto other existing life insurance policies, and there's a multitude of ways of doing it. Um,
Yeah, I was going to share actually. One of the things that we teach in the class about long-term care is, I always ask, what do people hate about long-term care? And they say, the unused premiums. What if I, use it or lose it, basically?
yeah,
And I always kind of chuckle, and I tell people in the class, I say, that's the only type of insurance that I hear that about. Nobody says, I hope
yeah,
my house burns down one day so that I can get, to get the money out of the policy. This is
yeah.
kind of the only type of insurance that people have that kind of negative, feeling towards.
Yeah. Yeah, I mean, other than permanent life insurance, pretty much all of our insurance is use it or lose it. I hope to never
Yeah,
use my home and auto insurance, either one of them. That'd be great. I've
yeah.
already used my homeowners insurance years ago, but hopefully never again. Um, but anyway, there are again two main types of long-term care insurance and insurance policies. And so the first is traditional. You may also hear this called conventional. Those are interchangeable terms. And then the second is called, there are new hybrid plans. And again, they have multiple names. They may be called asset backed or asset linked. And I just like hybrid. It's a shorter word. So hybrid type of plans. So first of all, they have some similarities. Okay. So both traditional and hybrid policies, they provide a maximum daily or monthly benefit. So for example, they might provide $300 a day for long-term care benefits, or they might provide, $9,000 a month, which, in this case, that'd be pretty equivalent. But they can be stated or counted different ways. So a maximum daily or monthly benefit. They also have a maximum long-term care benefit pool. And so, for example, that may be $500,000 or $1 million or whatever it is, whatever you purchase. But there's this large pool of money that you have access to. And a lot of times people talk about for so many months or so many years. You'll hear 60 months or something like that. For the most part, they're not measured in months anymore. There were older policies that were like that, but today's policies aren't really measured in months. You basically have a long-term care benefit pool, and then you have this monthly or daily cap. And if you don't use everything in that monthly or daily cap, for instance, say if you had a $9,000 monthly benefit but you're only spending $6,000 a month, then it's going to last longer than 60 months or whatever the months were estimated. It's just going to
Mm,
last as long as you have it until you've spent down the entire long-term care benefit pool. But there are some policies that even offer an unlimited benefit pool. And so in that case, you have a monthly limit, but you don't have any kind of, uh, permanent or long-term care benefit pool limit. They would pay for 30 years. If you continue to live and needed care for 30 years, they would pay that monthly amount for, an unlimited number of months. Um, all new policies today, and again, they're old policies that were sold, or purchased, decades ago. They're still in existence today, but this is no longer the case. Any policy purchased today is going to cover care, in a home care facility, or not in a facility, at home. They're going to provide home care. It'll provide care at an assisted living facility, or at nursing home facilities as well. And all of them do provide tax-free benefits. And getting into taxability of premiums and deductions and things like that, that can be complicated. That's beyond what we're going to discuss today. There are ways of having some tax deductions on the premiums, especially if you're a business owner. Um, or if you itemize, there's ways you can qualify for portions of the premiums to be tax deductible. What's important to most people is that the benefits are tax free. And so that's the real key that I want people to understand when it comes to their taxes. So these are things that both types of policies have in common. So now let's look at some of the differences, the key differences. There can be lots of differences, but key differences between traditional and hybrid policies. And so, David, as you mentioned, the traditional policies are use it or lose it, like most insurances, like your home and auto insurance, like your health insurance. And so that's not necessarily a problem, but people for some reason really don't like that, and it has been solved by the hybrid product. But the focus for a moment on the traditional, it is use it or lose it. The premiums can and typically do increase over time. Again, same with home and auto. Just as the cost of replacing a house, the cost of replacing a vehicle, the cost of healthcare, and obviously the cost of long-term care increases over time. Then premiums can also increase over time. Um, Now we'll take a moment and address. People have heard kind of horror stories of long-term care insurance increasing significantly,
yeah,
doubling, tripling, quadrupling more, over time. And
sure.
that was true, right? So the very first long-term care insurance policy was in the 70s, mid 70s. And of course companies were just guessing. They had to make guesses. They, made the most informed guesses they could, but they had to make guesses at what was going to happen in the future. And So it's probably again more than what we need to cover in this webinar, but there were a few key assumptions where they really did make good, educated guesses, and reality was just off.
Yeah.
And so to keep them in force, to keep the companies profitable and able to pay the claims, they had to increase premiums. And so there are policies today. I've had calls from clients, for years, not long-term care clients, like retirement planning clients, a couple of years ago,
Mhm.
complaining about long-term care insurance premiums going up, significantly, and trying to figure out whether to, reduce their benefits or keep the policy or pay the extra premium, what they wanted to do. Um, Today's policies, new policies sold today, the traditionals, they of course can increase over time, but it's unlikely. The states and regulators have come in and kind of seen what caused those problems, and they fixed them. And so while you should see some, just increases due to inflation, it's not likely to see these dramatic, increases over shorter periods of time as what happened with older policies.
Right.
So some of the pros, though, for traditional is that you can get the same amount of coverage for lower premiums, or you can, afford higher benefits from traditional. So they are the quote unquote cheaper, types of policies. On the hybrid side, these are policies that are they're combining some form of life insurance with long-term care insurance.
Mm.
And they did that not so much for the life insurance benefit itself, per se. This would not be something you would purchase if you're wanting life insurance. You purchase this for long-term care insurance. There are definitely better types of products for long-term for life insurance specifically. But they created these types of policies to solve the two biggest complaints that people had, and that was use it or lose it, and premiums increasing over time. And so with hybrid policies, there is a refund of premium or sometimes more if it's not used. So there's a death benefit built into it. And so, for example, I've seen clients who, they may put $100,000 in, kind of a single premium, one-time thing. These are typically folks who are retired who do that. But if they don't end up using their policy for long-term care, their family gets $100,000 back, or in some cases, they may get $250,000 back
Yeah.
in, depending on their age and health, in death benefit. But then, of course, there may be an even larger long-term care benefit pool that they're able to take from. And so there's not the financial risk there. They're going to, worst case scenario, they're going to get back the money they put into it, if not more. And then, of course, if they need care, which is that's not the best case scenario from a lifestyle standpoint, but financially, if they need care,
Yeah.
they're going to get even more, benefit than what was put in or what the death benefit is worth. The second problem it solved is that it fixes the premiums. So with hybrids, once you have a premium, whether that's a single premium or whether it's you paying for life or somewhere in between, the premiums never increase. And so if you're concerned about future, premiums increasing, the hybrid would solve that problem.
Mm.
The con, of course, is that the premiums are higher because there is this guaranteed death benefit. So the company's definitely going to pay back some amount of money, right?
Yeah.
And so in order to compensate for that, premiums are higher, or you have to be willing to accept lower benefits on the long-term care, portion of it. So really, both of these are fantastic products. I like and sell both. It just depends on people's preferences and what the situation is, and there's never a cookie cutter. We always have to go, look at everything individually and figure out what type of policy. And even within these two types, there's multiple companies with various other features, and we figure out what makes the most sense for those people. Um, and so finally, kind of getting into the specific question for this webinar is why earlier is better. I've heard financial educators say that you shouldn't start looking at long-term care insurance until you're 65, and some of them have kind of backed that down and said maybe 60 is the right age to begin looking at long-term care. I passionately disagree
Yep.
with that advice, and so I want to talk for a few minutes about why looking at it earlier is better. Um, and so the first, of course, is that you could require care earlier.
Mm.
Various accidents and illnesses could cause someone of any age to need care. David, the youngest client in our office to actually use their policy was 28.
Wow.
And it was due to complications for pregnancy and delivery.
Mm.
Now it wasn't, it didn't end up being long term like lifetime, right? But
Sure.
it was long term like months.
Mm.
And so the policy paid, and then of course they still have it for down the road whenever they may need it again. Unfortunately, I had a friend that I met at CrossFit several years ago. He actually started going to CrossFit because he was, I guess he's probably 40 at the time. He started going to CrossFit because he was having just some health complications and wasn't
Mm.
sure what was going on. So he was trying to get in better shape, and turned out he had ALS, and
Mm.
so it was a slow, pretty
Yeah.
terrible terrible decline, of his health. And I I don't know whether he had long-term care insurance. I doubt it.
Mm,
But he certainly would have needed it, would have benefited from it, and would have been using it for years. And he was there was no other indications to think he would have, that kind of health problem at 40. And so
mm,
again, you could need it earlier than retirement age or earlier than the last few years of your life. And so having it obviously is better than not having it.
yeah.
Next is because the younger and healthier you are, the lower your premiums will be. Um, and so that one's kind of obvious. It's like life insurance. The healthier, the younger, the least you're going to pay in premiums for long-term care insurance. But the number one reason, and please, don't miss this. The reason to begin planning for and even purchasing long-term care insurance as early as you can is to ensure your insurability.
Mm,
To ensure your insurability, and insurability means your ability to qualify with health qualify for some type of health-based insurance. And obviously, we're talking about long-term care. You wouldn't believe how often people come to us and they're ready and able and wanting to purchase insurance. And typically it's because they've gone through a similar experience to the Winsteads. They've
yeah.
just helped mom and dad, and now, or they've helped their spouse, right? Maybe this was, Ruth coming to us after Bruce passed
Mhm,
away and saying, hey, I need help. Um, but they no longer qualify due to some kind of health condition.
mm,
I mean, just this week, I met with someone yesterday. I met with two people yesterday. One of them can't get long-term care insurance due to a health concern, and she is not concerned, an issue. She is 45 years old. Another that I met with yesterday, another couple, are older, but it's health, not age, that's going to
mm.
force them to either pay double or get half the coverage they need
Wow.
because the husband can't qualify for the policy that would be best for them.
Mm,
It's a really, it's a frustrating situation because I want to be able to help them with it, but it is what it is. And so, obviously, when you're younger, you may earn less, you may be paying for multiple kids, you may be paying off debt, you may be trying to save, and it can seem like long-term care insurance shouldn't be a priority at the moment. But here's the thing. Here's what I want people to keep in mind. You don't have to purchase all the coverage that you may need in the future.
mm,
We call this a stacking strategy, and it simply means that you can purchase, what you can afford today, and guarantee that you'll at least have a minimum amount of coverage, right? And then in 5 years or 10 years, you can purchase a second policy, and then later a third. And so this allows you to, allows premiums to be more affordable. It gives you some protection today, which obviously can be needed, and most importantly, it allows you to ensure your insurability. So if you get to age 55 or 60 or whatever, and you no longer qualify, you have some policies in place. It may not be
yeah.
what you would have ideally liked to have, but it's certainly going to be, better than nothing.
Yeah, and you have a
Um,
foundation at least.
right, exactly. And it's interesting, if you end up getting to a point where you feel like you don't need as much as you once did, you can cancel the one that cost you the more and keep the lesser premium ones in place, and
Mhm,
it gives a lot of flexibility. So it's a really great, fascinating strategy that we really recommend for folks who are 30, 40 years old, and then obviously by 50 to 70, we're trying to look at like let's just get everything done,
mhm,
as much as you can get at that point.
yeah.
Um, so final slide, and then if there's some time for questions or something, that's fine as well. Um, so you can visit ltccinc.com/webinar. Admittedly, we are in the process of revamping the website. So that'll be done in the next month or two. I'm very excited for that to be done. So this is just a form. It's not the main website. It's not very pretty, but it's a form, and it will allow you to get more information and to schedule a call with me if you have any just questions. Obviously, if you don't want to look at a policy or anything like that, but even if you just have, want to schedule a 15-minute call to ask some questions, this is the best way to get in touch with me and continue that conversation.
Yeah, I have a couple follow-up things, but I just want to encourage everyone who's watching, reach out to Jared. This is a no cost, no catch, consultation that he'll offer his input and his thoughts on. So take advantage of that. I mean, Jared and I met through understanding what God's word said on our finances, and so being a good steward uh, uh, is often just taking that first step and taking a step towards how can I protect my family and how can I do the best with what God's given me. So take advantage of that opportunity that he's providing. I put the link in the chat box, so if you have questions, schedule that time with him. A couple of things I wanted to highlight. I know we mentioned, Medicare does not pay for long-term care. I just want to highlight that again for people that might have missed it. The other thing I want to mention is when I teach a tax planning class, one of the things that we highlight is the tax-free aspect of these hybrid policies. And I just think people are missing the boat when they don't consider that as a viable option, because it's such a huge opportunity when you think about tax rates and what tax rates will be doing in the future. Maybe think 10, 15, 20 years. We don't know what tax rates will be. We know we are at historic lows now, but we don't know what they'll be in the future. And so taking advantage of an opportunity to reduce our taxes, or I always like to buy out the government as soon as I can. And so this is
Yeah.
another opportunity to do that. And finally, I just want to say, people are always wary of different types of insurance risk, right? So they, because they don't think about that it's going to happen with them. I did an estate planning class with an estate planning attorney last week, and the biggest thing that people said was, I never thought that this would happen, because they went through probate with their spouse, or with whatever the case, their parents. They just don't think that it's going to happen. And full disclosure, I don't think that I'm gonna, I don't think about long-term care, every day either. And I think, but just as you get older and as you age, I think it's very important that, you know, when you don't want to have to call Jared is when you're going in, you have the need for it right then and there. And so it's always better to prepare for
Mm.
long-term care than it is to repair the long-term care cost. And so I just encourage you to reach out to Jared, get some information, get knowledge, get the wisdom that you need to really prepare yourself and prepare your family to be a good steward.
Yeah, I think it's very much like life insurance and disability insurance. I own a significant amount of life insurance and I do not expect to die early.
Yeah.
I don't think it's going to happen, but the consequences would be catastrophic to my wife and, 4 children for now. And, same thing with disability insurance. I don't expect that to happen. I'm in good health. I don't do anything particularly risky,
Yeah.
but if it suddenly went away, due to some kind of accident or whatever, it would be devastating. And so, it's the if, right? And how
Yeah.
bad are the consequences if it happens? And I know it can, right? I mean, I've known people, die in car accidents at 30 or, 27 and, leave a spouse and child. And so,
Yeah.
yes, I'm happy. I'm happy, not always happy, willing, obviously, to pay for those insurance premiums,
Yeah.
that I don't expect to use because I greatly desire for them to be there if,
Mm.
if that happens.
Yeah. So Jared, I want to ask, what are maybe some
Sure.
of the common misconceptions that people have when it comes to long-term care? I mean, I know we talked about a couple of them. The use it or lose it. Are there other
Mhm.
common misconceptions that people come to you and kind of light bulb turns on when they talk to you?
Yeah, I think there are two. I think one that it's too expensive.
Hmm.
They'll say, "Hey, there's no way I can afford it," and it can get expensive. Like I won't pretend like it's not, but
Sure.
especially if you do start earlier, it can also be very affordable.
Mm.
Um, and so how expensive it is to some degree depends on how long you procrastinate on taking care of it.
Mm.
The couples who are 70 years old plus and who are coming to get it, yes, it is pretty expensive. It's a decent check to write. Um, but they also realize that they're at that age, if they're both living at 70, they're likely to live a long time. They're very likely to need it. And, it's much cheaper to pay insurance than it is to start writing a check for 60 to $120,000 or more a year,
Mm.
plus the taxes, it probably take to write those checks on top of
Yeah.
it. And so they're willing to do it. But if you're in your 30s, 40s, even 50s, it is far less expensive than I think most people think that it's going to be. And so I say to take a look at it there. Um, the other one, as I think, just a lot of people don't understand, what long-term care insurance really is, what it does pay for,
Mm.
and so that's why I like to highlight that story of the Winsteads and try to help, paint the picture of what care is really like, and the
Mm.
emotional, the physical, strain, the financial
Yeah.
strain, and it puts not on the person receiving care, on their loved ones, right? Their
Yeah.
spouse, their children. There's often one child. If it's children giving care, there's often one
Yeah.
child giving a lot of care, and maybe other siblings who are not, and that's not great for family
Yeah.
relationships. And um, I think people don't realize how grave the consequences of not being prepared can be. And unfortunately, I hear those stories all the time now, and it's significant. And for most families, it would be pretty easy to avoid, pretty easy to deal with by just, like you said, preparing
Mm-hmm.
rather than trying to repair when that time comes. Um, I guess a third one is hearing all the horror stories of old
Mm-hmm.
long-term care insurance policies, and that that's legitimate. Like I've seen policies that quadrupled, in
Yeah.
price over time, and if you're not prepared for that, that would be a hard position to be in. But
Mm.
um, I guess if we have a little bit of time, I will share kind of why that happened.
Sure.
And so this is getting technical, but it helps people understand. So, David, when those policies were first being underwritten, the actuaries were working on it. They had to make several assumptions. You have to figure out, think about how many policies are going to have claims, how much
Mm.
those claims are going to cost. But one of the things they have to assume that people don't think about is how many of those policies are going to lapse.
Mm.
Like term insurance, right? People buy term insurance, they don't expect to keep it for the rest of their life. They expect to lapse those policies or to stop paying for or let them cancel at some point.
Right.
And so they make assumptions on what that's going to be. And across the insurance board, most types of insurance have a lapse rate of about 5% per year. So if a company sold 100 policies, about five of them each year are going to lapse. And so once you
Sure.
get to later in life, there may be, you know, 10 to 30 of those original 100 on the books at that kind of
Mm-hmm.
lapse rate. The most sticky, so to speak, insurance policy that existed at the time was whole life insurance. Those were rarely canceled. They had a lapse rate of 3%.
Mm.
And so after about 20 years of selling long-term care insurance and giving it time to see what happened, the original long-term care policies had a lapse rate of 1%. And so where insurance companies expected there to be 10 or 30 policies on the books, there were about 90 policies still on the books. And
Wow.
as you can imagine, that made it really difficult to, actually pay claims, which they have to
Mm.
do. And so they were forced to, increase premiums dramatically in order to
Mm.
be able to keep their promises, which, everyone who's the 90% or whatever people who kept their policies want them to keep their promises and be able to make those payments. So,
Mm.
so to solve that today, the, um, just insurance regulators force them to use a lapse rate assumption of it's either 1% or maybe even less than
Mm.
1%. So they have to price accordingly. But that
Right.
means that they don't have to, just dramatically raise rates over time
Sure.
in order to pay their claims. All the other assumptions were pretty spot on. That was the one that really was the trigger. So I
Mm.
feel like that story helps people understand. Okay, that
Yeah.
makes sense why it did that, and even if cost of care does increase, I shouldn't expect dramatic increases for
Yeah.
the traditional type of policies.
Okay. Yeah, that's helpful. I think it's good to have some background there because there are a lot of concerns and fears when people go
Yeah,
into this because of the horror stories. So
yeah.
before we close out, Jared, one question did come in before the webinar, and it was someone
Okay.
asking, and this might be more personal. They might need to schedule a call, but someone was asking if they weren't in the best health, would one of the types of policies might be more applicable? They said that they were searching and were thought that maybe hybrid might have less stringent requirements. And
Mhm.
so, don't know if you want to have any thoughts on that or want to speak to them about that.
Yeah, in my experience, the hybrids do have slightly less stringent qualifications, but that
Mhm.
definitely is a case by case basis. Whoever that is should schedule a call. We can evaluate, and what we can do is we can kind of do a pre underwriting indication with the company, and it's more about the company than the type of policy. So some
Mm.
companies are more conservative than others, and there are some Plan Bs, right, and even Plan Cs. We have some policies that we didn't talk about today that aren't quite the traditional. They're not quite the hybrid, but they can provide long-term care benefits. And sometimes people can't qualify at all. But what we
Mm.
talked about today was Plan A. But we can also look at Plan B and Plan C, and find some types of coverages there as well.
That's awesome. Well, I want to say thanks to Jared Williams. Really appreciate it. Again, if you have questions about long term care or you want to learn more about what options are available to you, reach out to Jared. The chat box. Do you want to put up your website again? I know it's ltccinc.com/webinar, and you can schedule some time with him and get that conversation started. Yeah,
That's the
ltcci.inc.com.
main website, but preferably, go here for signing up for that, and there'll be some specific, emails coming out after that.
Perfect. Okay. Well, thanks again, Jared. Appreciate everyone joining us today. And like I said, if you have questions, reach out and Jared will be happy to answer them for you. Thanks again.
For sure. Thanks, David.
Bye.